Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Friday, 27th of June, and this is your Capital Economics Weekly Briefing. Coming up, BYD, DeepSeek, and China's paradoxical tech leadership. But first, Group Chief Economist Neil Shearing joins me to run through the big issues in global macro and markets. Hi, Neil.
Hi there, David.
Usual caveat, it's 9:30 in London Friday morning. That's 4:30 a.m. in DC. News moves pretty fast these days. But I see the sun is shining in London. Our asset allocation outlook was published yesterday. The title was The Calm After the Storm. We've got a Middle East ceasefire that seems to be holding. Trump officials signaling the tariff deadline could be pushed back. There's a US-China deal in the headline. Inflation data looks pretty benign. Hard data looks pretty benign. S&P at a record high. I mean, how much good news can we take? Is this what a sweet spot looks like?
For those of us based in London too, there's a heat wave on the way apparently as well. So summer might finally be here. Look, I wouldn't quite go so far as to say that we're quite out of the woods. I think everywhere you look, things seem to be pretty benign, as you say, but it's also, there's a lot of fragility under the surface. So yes, the hard data in the US are holding up reasonably well, but I think it's only a matter of time before they start to soften. And if you look outside the US, in Europe, for example, we're talking just on the release of some economic sentiment data that still seems to be consistent with GDP essentially being flat. In Europe, the economic picture is not so great. We've just had that big fall in car production reported in the UK. When you look at the Middle East, the truce between Israel and Iran, as we discussed earlier this week on a special podcast, that looks pretty fragile too. The US-China détente, yes, good news. Both sides have sought a deal. That deal appears to be signed, but we've not seen any details. And there's plenty of ways that could fall apart. We've written extensively about that. Our China team has. And then that's without talking about the fiscal package working its way through Congress and fiscal risks both in the US and in other countries too. So, I mean, I don't want to be a Debbie Downer on all of this, but I think I would characterize it as the global economy is muddling through at this stage, pretty much as we said it was going to do. But we're muddling through rather than collapsing, but nor are we quite yet out of the woods. I think we can sound the all clear. Everything's going to go to the races.
We are what Australians used to call whinging poms, but let's get into more of what could go wrong from here, because that's certainly my comfort zone. You mentioned that fiscal package, those tax cuts working their way through Congress. It sounds like there's a fight in the Senate over what it's going to do to the federal deficit. At the same time, we've had this NATO summit this past week where NATO members have agreed to raise direct defense spending, and there's questions about whether they can afford to do so really. The UK government is barely 1 year old and it's had to backtrack on spending cuts because of a party revolt. So, as you say, sun's shining for all this good news, but talk about these fiscal risks and how they're bubbling under the surface and how they could upset what's going on.
Yes, I think there are two things that are distinct here. One is what's happening in the US with the fiscal package working its way through Congress that will extend the original Trump tax cuts. Of course, we've got to talk about tariffs there too as well, because that tariffs are not part of that fiscal package, but they would do some of the funding of the tax cuts. That's the issue in the US. In Europe, it's really about how does Europe find the fiscal resource to finance higher defense spending against the backdrop of, Germany aside, some pretty strained public finances. The approach in the UK has essentially been to kick the can down the road, promise jam tomorrow in the form of higher defense spending. That's all kind of coming back end of this decade and by 2035. And in the meantime, the government has an almighty battle on its hand with backbenchers over welfare cuts. And in continental Europe, in the Eurozone, in France, for example, no real fiscal space to increase defense spending without cutting elsewhere. Spain is an interesting one because Spain actually does have the fiscal capacity, in our judgment, to increase defense spending, but for domestic political reasons has been allowed a kind of an exemption from this push by NATO members to get defense spending to 5% of GDP. Andrew Kenningham, our chief Europe economist, put out a note in the past week looking at what will happen to public debt burdens in Europe if all the NATO members raise defense spending to 3.5% of GDP by 2035. His conclusion was it would increase public debt burdens by about 10 percentage points of GDP, and that would increase fiscal risks in a number of countries, France and Italy being the most notable, but also Belgium. So when it comes to defense spending and those commitments, there's a big question mark about how this is going to be paid for, because additional borrowing is going to put strains on public finances.
Okay, you mentioned that US-China deal suggested that there's not as much there as headlines would suggest. Talk a bit about that. Talk about what could go wrong with that relationship, but also maybe what's the economic impact of this US-China tussle?
So the first point to make is that the deal itself is pretty limited. We've discussed this before, haven't we? Essentially, it was an agreement to roll back tariffs from those extremely punitive rates at 100% plus that we reached in early May to rates that are still pretty extreme. So at the moment, the average tariff rate on imports to the US from China is still averaging somewhere close to 40%. So that's still an enormous increase in the tariff rate. So it's a pretty limited deal in the first instance. It only rolls back part of the increase in tariffs that the US has imposed on China. And of course, China has kept in place some reciprocal measures. The deal itself, we're told it's signed, but both sides tell us that it's been signed, but we have not yet seen any details. There's no written text that goes alongside this. Now, that might be in the works, and we might get that over the coming days and weeks. But from what we can tell, essentially the agreement is that China will agree to export rare earths to the US, and once those exports start flowing, the US will start to cancel some of the countermeasures that it put in place. Now, it's unclear exactly what those countermeasures are, but we're taking it to mean that it was the 24% increase in reciprocal tariffs that it paused until August the 12th, and will go up without an extension of that pause then. So it's a pretty limited deal is the first point. Details are thin on the ground is the second point. And then the question is, what's the economic fallout? I think there's a danger that we tend to view the issue through the lens of the US or the lens of the West. And if you view it through the lens of China, I think you arrive at a slightly different position. And the starting point here is that China's economy has been struggling. We know that. If you look at our latest China activity proxy, which is our own proprietary measure of economic growth in China, that's pegging growth at the moment at around 3.7% year on year. So weak and well below the official target of around 5%. Now, to some extent, that's not new news. Growth's been running on our CAP measure around or just below 4% for a while. But if you look at the constituent parts, wind the clock back 6 months, what was happening was you had a weak service sector reflecting the weakness of domestic consumption. You had a construction sector that was on its back, reflecting problems in the property sector. And you had a manufacturing sector that was doing a lot of the heavy lifting, that was growing at 5% year on year. And a lot of that output, because of the weakness of domestic demand, was being shipped to external markets, to export markets. Now, the US has imposed tariffs, trade restrictions on those exports. And we're starting to see the first sign that Chinese manufacturers are struggling. So in our latest CAP measure, we see that the industrial sector is starting to take a bit of a hit. So I think viewed through the lens of China, these tariffs, even with a deal to roll them back and reduce them, are a big deal, right? Because we still end up with tariffs, US tariffs on China at historically high levels. And we've got to have a Chinese economy that is becoming increasingly dependent on exports to sustain demand because of this high savings, high investment growth model, expanding capacity against the backdrop of weak domestic demand and weak consumption, so that production has to be shipped overseas. So all of this is storing up a problem, I think. Now, in the near term, how does that get resolved? I think Chinese exporters try to find other ways to get exports to the US market, rerouting them through third-party countries, for example, and our proprietary measures of transshipment are showing some of the signs that's already happening. They're also going to seek out new markets, particularly those, for example, in Europe, but also other EMs. Now, over time, I suspect the next step is going to be for governments in those countries to start to push back against this flood of Chinese exports. So to get us back to your original question about if it's not springtime, it's summertime in London, things are looking good, the markets are on a high, all these kind of economic risks are receding into the background and are easing. Actually, there's this big structural issue starting to come to the surface. And I think that's going to be the key thing to watch over the next 12, 18 months, 2 years.
Okay, before you go, I have to ask you, it's been an interesting, to say the least, week for Fed watchers. We have this Wall Street Journal story talking about Trump naming a successor to Jerome Powell well ahead of the end of his term in May next year, something we've discussed on this podcast. White House has since pushed back on that story. But then at the same time, we've seen signals that the FOMC is divided in terms of where rates go next. Putting all of this together, what does this mean for the outlook for US rates? What does it mean specifically for the July meeting?
So I think the big news coming out of the last Fed meeting is growing evidence that there are two camps now on the FOMC, those that are starting to push for more immediate rate cuts and those that are happy to wait it out. And now at the moment, the latter's in the ascendancy. I suspect at the next meeting that will remain the case. I don't think we're looking at near-term rate cuts because of uncertainty around inflation and the inflationary effects of tariffs. But in the background, you're right, the politics of the Fed is starting to shift. We've had noises off through the media about, as you say, the idea that Powell's replacement could be announced earlier than is usually the case, and that we might end up with a kind of shadow Fed chair that would be chirping from the sidelines, as it were, pushing for rate cuts. I find it difficult to believe that's going to have a big effect on decisions month to month. In fact, I think to the extent it does happen, actually, it could be entirely counterproductive, because if you start to think about what the impact in bond markets of that development such as that might be, I think you start to see concerns about policymaking in the US rise, concerns about institutional drift build, and term premium on bonds rising. So actually, the president's pushing for lower interest rates and lower borrowing costs. Actually, we might see a sell-off in US Treasury markets and yields heading higher under those circumstances. I think it, far from being a way of nudging the Fed into cutting rates earlier and signaling intentions to investors, actually the whole thing could backfire. And at the long end of the curve, we could start to see yields rise. In the short term, no rate cuts, I don't think, for the time being. In the long term, any push towards a shadow Fed governor in trying to influence investors' rate expectations, I think could end up ultimately backfiring.
Neil Shearing on that US-China deal, what could go wrong with that? And on the Fed, reminder, we were speaking before the release of the latest monthly PCE inflation data. I will add our rapid response to that release to the podcast notes. On Fed independence, Tom Matthews from our markets team has written the Capital Daily all about this noise around the Fed and how it could make things worse for the dollar and long bonds. I'll add that to the podcast notes too. Capital Daily is out each trading day. It's a short note with focused, forward-looking analysis on the very hottest issues in global markets. It's also a guide to all of our written output each day. So this is one way of making sure that you're seeing what the team are producing. If you're not getting Capital Daily, then do speak to your account manager. They will get you set up pronto. Neil and I mentioned that UK Labour government revolt. It's something that our UK team is going to be discussing with clients in an in-person roundtable in our London office this coming Tuesday, 1st of July. There's only a couple of seats left, so do get in touch if you want a place. They'll be briefing on the UK outlook, but it's also a chance to meet the team and network with other capital economics clients. I'll add details of that event to our podcast notes too, but as I say, limited spaces, so do get in contact with your account manager if you want to reserve one. I also want to mention that our Asia Pacific commercial real estate coverage that we flagged last week has now launched. There's an inaugural commercial property outlook. That's all about what the team think is going to be the weakest recovery on record for the region. But there's also an interactive data dashboard so you can explore and download their forecasts for the region's biggest markets and sectors. Again, check the podcast notes. That will have links to the report and to the dashboard. Now, Neil and I were talking all about China's structural economic problems, but that's just one China. The other China is a technology pioneer that's producing firms operating at the very cutting edge. These firms are upending business models, industrial strategies, and market assumptions across the advanced economies. But there's a paradox at the heart of all of this that Mark Williams has explored in detail in a recent report. Mark's our Chief Asia Economist, and his report title, China's Push for Innovation is Not Lifting Productivity, says it all. We spoke recently about China's technological marvels, Xi Jinping's industrial hopes and dreams, and why, for now at least, this is all looking like a productivity disaster. Here's that conversation now, and it begins with me asking about what the rise of EV giant BYD and the sudden emergence of AI disruptor DeepSeek signals.
So I think without doubt, we are seeing the emergence of some fearsome competitors for global companies in the likes of, as you say, DeepSeek, BYD. We shouldn't forget that they are coming from a landscape. And in fact, part of the reason for their success actually is because they're emerging from the incredibly competitive domestic landscape. So I saw some figures the other day that said that China has well over 150 automakers, and more than half of them have less than a 0.1% market share. Certainly within the EV sector, almost none of them have ever made any money. The BYD is the exception to this. BYD is making money and has a significant market share. But the way it's got there is because there's this incredibly competitive domestic sector and it's emerging from that. A lot of the other ones, though, are going to fail. Quite clearly, they're going to go under. And so when we're thinking from a broader macro sense about whether the emergence of BYD tells us that China is succeeding in terms of kind of industry overall, you have to net off the fact that you've got all of these failures against the success of BYD. And those failures, it's not just companies vanishing or brands vanishing, but you've got huge amounts of investment that have gone into their car making plants that is essentially wasted, could have gone elsewhere, didn't go elsewhere, could have been supporting consumer spending, for example. There's been huge amounts of subsidies have been backing up these automakers, both from the central government, from local governments. Banks have been providing cheap capital to many of them. So the losses from this are pretty substantial. It's correct to focus on the successes and the fact that BYD looks like a really successful company, but we need to remember there's a lot of failures there too.
You call them failures, but they're still going concerns. And they've been talking about consolidation in the EV industry in China for years, and it hasn't really happened yet. And the fact that they've been allowed to stagger on does point to, doesn't it, this highly interventionist state industrial policy. So talk a bit about that and talk about how that's affected economic development.
Yeah, I think this is important that China has this really activist industrial policy, and it is huge overall. It could be, one study I saw suggested as much as 5% of China's GDP is being spent every year on industrial policy in various different forms. So that is subsidies, there's tax breaks, there's the use of public procurement to support certain firms, there's cheap financing from banks, also from government-owned funds. There's a huge number of measures that are used to support different sorts of companies. And at the highest level, the way that Xi Jinping talks about this, he was quite clear, for example, in the third plenum last year, saying that the purpose of this, the goal of this, and the success of this will come from boosting overall productivity growth across the economy. And we can talk about the degree to which it's succeeding in that, but that at least is a pretty clear metric for success. But I think that when it comes to the implementation of the industrial policy, the officials who are making the decisions about which companies get the subsidies and so on, maybe they've got other things in mind. And in particular, I think there's some pretty strong evidence that employment is a factor that they're thinking about. So if you're at the local level and you're looking at a local car maker, which is teetering, then in the mind of a local official, they might be thinking, we should support them. We need to keep them going because otherwise we're going to have a local unemployment problem on our hand. But then that creates a perverse feedback because Xi Jinping said the whole point of this was to boost productivity growth. But you've just got a local official who had actually actively given the money to the least productive company, the one that otherwise would be going out of business.
There's so much in China, it does come down to this tension between the sort of central government, centrally directed economic policy goals and what's happening at the local level, and the local level need to meet their own targets. You always seem to have this tension.
Yeah, so you've got all these different levels of government maybe pursuing slightly different goals. But it's also even the case that within the central government, even I think within the mind of Xi Jinping, that there are different goals. So although he says that the purpose of industrial policy is to boost overall productivity growth, he clearly also sees it as an important part of China's response to the geopolitical position that it finds itself in. One of his signature policies is this dual circulation idea, which is about making China less dependent on inputs from abroad and trying to make foreign countries more enmeshed with China at the same time. And industrial policy, I think, is quite clearly being used to that end, to try to make, to build up domestic capabilities. So China needs to import less of high-end technology, does it itself, and build up exports, even if that means potentially supporting some loss-making firms, but building up exports so the rest of the world becomes tied into Chinese supply chains. Now, that might make a sort of a degree of sense from a geopolitical perspective, but it's absolutely not the strategy that you would follow if you really were trying to boost productivity growth across the economy. It's the opposite in many ways, because what it ends up with is China trying to replicate domestically things that it could just import. There's cheap chips that they could have got from abroad, but instead, for possibly very good strategic reasons, they've decided they're not going to rely on importing them from abroad because they're worried that they won't be able to in future. They're going to build it at home. All of that cost takes resources, and resources are not free. Those resources could have been used elsewhere, could have been used more productively elsewhere. So there's these huge tensions between the way that industrial policy is being used, which I think has meant that it hasn't had the results that Xi Jinping was hoping for.
What I think your analysis does really well is frame this very much in the context of Xi Jinping's development goals, because it's so easy to think about what's happening in China in terms of subsidies sloshing around and overcapacity as a byproduct of just this effort to prop up the industrial base that came in part out of its response to the global financial crisis. But what you're saying is that actually what we're seeing here is an effort to meet Xi Jinping's goals of raising productivity, and that it's actually having the opposite effect. So talk about what has happened to Chinese productivity growth since Xi has enshrined all of these goals.
Yeah, so this is the crux of the issue. I think this is really interesting. All of us who look at China are used to these two narratives about China being widely reported over the past few years. So one of them is China's emergence as this competitor in lots of cutting-edge sectors. So we've talked about EVs and BYD. AI is the other sector, which clearly has been in the news a lot recently with DeepSeek. But there's other sectors as well, things like high-speed rail. China originally was dependent on foreign technology, but has indigenized that, as they say, and is now exporting fully indigenously developed trains. We can look at nuclear reactors. That's another area where China is now at the forefront and is exporting. So China has genuinely gone to the forefront in technology in a whole range of sectors. And I think it's fair to say it has done that far quicker than a lot of people had expected. Because after all, China is still not a rich country overall. It's still a middle-income economy. However, the other story that of course has been going around about China for the past few years is all about the weakness of its economy, the fact that its economy is not growing as rapidly as people had expected it to. So there's been a litany of stories year after year of China's disappointing in macro terms. So both of these things have been reported. And the key, I think, is that both of these things are true. And certainly in overall productivity terms, there are a number of different organizations have tried to measure this. And they all show that productivity growth dropped off fairly sharply in the early 2010s. You can say that it did that after the global financial crisis, or you could equally say it happened just after Xi Jinping became China's leader, depending on what point you wanted to make. But clearly it happened just after this wholesale adoption of industrial policy. The two things happened together, and I think there is increasing evidence that the slowdown in overall productivity growth was actually caused in part by the state's embrace of industrial policy. There's been some really interesting studies done looking at firm level productivity across China, looking at the subsidies that companies have got. And that has tended to find that there's an awful lot of perverse outcomes, that it tends to be within a sector, the less productive firms are the ones that got more subsidies rather than the more productive firms, and that subsequently they became less productive overall. There's studies showing that incentives to create more patents, for more innovation, did result in more patents, but less innovation overall because companies retooled themselves to just generating patents. So I think there's pretty strong growing evidence that the wholesale embrace of industrial policy by China's leaders has had some perverse effects overall and has contributed to the overall slowdown in productivity growth across the whole economy. The backdrop, of course, is that it hasn't just been subsidies and all these kinds of things. There has been a broader embrace of sort of state oversight of parts of the economy over the past 10 or 15 years that I think has also contributed to this. So that's happened. Now, it's also true that we've seen these kind of world-beating companies emerge at the same time. I don't think there's necessarily any contradiction there. A lot of money has gone in. There's huge competition within China's industrial sector, and that is an environment that can create some winners and some really impressive winners. But when we're talking about those winners, we shouldn't lose sight of this broader picture, which is that an awful lot of resources have been wasted. And overall, it does seem to be the case that for all the successes of BYD, overall China's industry has been repeatedly disappointing and showing slower productivity growth over the past few years.
So how does DeepSeek fit into this model? Because offshoots of Hangzhou-based hedge funds really aren't part of China's industrial policy, are they?
Yeah, so that I think DeepSeek actually is in some ways perhaps a more interesting example of what's going on with China's industrial policy than BYD is, because BYD and the broader EV sector, they've benefited from subsidies for a very long time. In fact, China has what it calls its strategic emerging industries, and EVs were one of the original ones back in, I think it was 2009. So loads of money has gone into that sector. And even though the subsidies have been hugely actually reduced since the 2010s, they're still pretty significant. And by one estimate, BYD last year was still the third biggest recipient or listed recipient of subsidies in China. If we look at DeepSeek, though, by contrast, now, China has been a bit ahead of the game. AI has also been one of the strategic emerging industries in China since 2016. For the best part of a decade, companies that are in the AI sector have been able to benefit from a huge amount of government support, whether that's subsidies or a lot of the way that this works in so many sectors is that there's tie-ups with government research institutes and so on. And I think it's very likely that China's big tech companies have been availing themselves of this support. What's quite striking about DeepSeek is that it doesn't really seem to have been a major beneficiary of government support over the past few years. Instead, it was just spun off from a hedge fund that was using these models to help with algorithmic trading. So I think that's really telling that you've had these huge firms, your Tencent, your Alibabas, that have had a lot of support to help them, give them a leg up in AI. And which company was it that made the massive advance in China? It wasn't any of those companies that have the links to the state, the links to the subsidies. Instead, it was a relatively unknown private sector, the company that it does seem largely did it by itself and did it as an offshoot of its other activities, including funding it itself. It was financed from the hedge fund rather than it having to go to the government for funding.
So DeepSeek succeeded because it didn't have that government, all those subsidies, that state help, rather than in spite of the fact. Is that how you'd frame it?
I don't think we know that I don't think we can say that it succeeded because it didn't have the state support, but it's quite striking that the one big success was one that was not that close to the state. And I think that there is a broader message there that Chinese firms can be really innovative, really productive, but more often than not, when the hand of the state gets close to them, then it squashes some of that productivity and innovation.
And DeepSeek's whole model is it's innovative in as much as it's managed to do things that much bigger companies, much better funded companies with much, much better tech stacks have done, but much more cheaply, much more efficiently.
Yeah, it's got some really smart people. They've obviously got a lot of capital. They've been able to generate themselves, but they've been able to do these things that their domestic competitors that are much better capitalized and have much better connections to the state haven't been able to achieve.
So what happens now? Do we see 100 DeepSeeks blooming, or does China, the government, continue pouring massive amounts of subsidies in this giant industrial policy? And if so, what does that tell us about the outlook for the Chinese economy?
So my sense is that industrial policy is seen by China's government to be succeeding. I think that it's always possible to point to the successes, to the BYDs, perhaps not DeepSeek, but DeepSeek is now being embraced closely by the state and is now being described as a Chinese champion. So I'm sure that fairly soon people will be thinking that this is in some way the state helped there as well. So I don't see any sign that the tap of subsidies and industrial policy will be turned off. And I think then that points to a future in which we will see more individual Chinese companies emerging that are highly competitive at the cutting edge, that are making life very difficult for firms abroad and gaining global market share, while simultaneously we'll see Chinese industry struggling, more companies losing money and struggling to keep going. And so slower productivity growth across the wider economy. And if you're interested in how fast China's economy is going to grow, that's what matters. It's the growth of productivity across the whole economy that will determine that, not whether or not there are some world-beating companies emerging from China. And the analogy that I draw in the piece on this is with Japan in the 1990s, that we think of Japan in the 1990s as being in the start of its lost decade. But Japan at that stage was still a highly innovative company. It was at the cutting edge in consumer electronics. Its auto sector was the world's leader. There is no fundamental contradiction between an economy that is at the cutting edge, is pushing the cutting edge forward in terms of technology, but is still really struggling in a macroeconomic sense.
That was Mark Williams on China's global tech leadership and what that says about its collapsing productivity growth. I will add a link to Mark's report in the podcast notes. If you're not getting our China coverage and you want to see Mark's analysis, you want to see the team's work on US-China relations, you want to see that proprietary China activity proxy that Neil mentioned, this is all available as part of access to CE Essential and CE Advanced. These are our all-access packages. They come with data, with ways to engage directly with the Economist team, and with much, much more. Get in touch to start getting that access today to make sure you're not missing anything in global, macro, and markets. Even if your focus is quite narrow day to day, Essential and Advanced give you that bigger perspective so you're prepared for when uncertainty hits. And as Neil and I discussed, the sun is shining, the global economy looks like it's muddling through, but there's plenty bubbling under the surface to upset all of that. We'll get into some more of that next week when we unpack the latest US non-farm payrolls numbers and bring you much more from the world of macro and markets. Until then, goodbye.